Hello and welcome to marketing91.com. Let's start with understanding commercial banking. A banking company means any company which transacts the business of banking. Banking means accepting for the purpose of lending of investment of deposits of money from the public, payable on demand or otherwise, and withdrawable by check, draft or otherwise. Functions of commercial banks are divided into primary and secondary functions. Primary functions includes accepting deposits, making advances, and credit creation. Secondary functions include clearing checks, selling or purchasing shares and bonds, transferring money, serving as trustee, serving as representative, paying and accepting money, and providing letters of credit. The first primary function of commercial banks is accepting deposits. Commercial banks accept various types of deposits from the public, such as saving account deposits, recurring account deposits, and fixed deposits. Making advances. Commercial banks provide loans and advances in various forms, such as demand and term loans, overdraft facility, cash credit, and bill discount. Credit creation. While sanctioning a loan to a customer, a bank does not provide cash to the borrower. Instead, it opens a deposit account from which the borrower can withdraw. This process is known as credit creation. Secondary functions include several agency and general utility functions, such as clearing checks. Commercial banks collect and clear checks, dividends, and interest warrants. Selling or purchasing of securities. This includes the sale and purchase of shares and bonds. Transfer of money. Commercial banks provide money transfer facilities. Serving as a trustee and representative. Banks act as trustees, attorneys, correspondents, and executors. Paying and accepting money. Banks allow making payment of rent, insurance premium, various bills, etc., and accept tax proceeds or tax returns. Providing letters of credit. Banks provide letters of credit to importers to help them carry out trade activities. Moving on to assets and liabilities. The balance sheet of a commercial bank is a statement of its assets and liabilities at a particular time. Assets of a bank refer to items from which the bank expects to earn an income or through which it tries to protect its interests. Liabilities of a bank include payments to be made by the bank to shareholders, depositors, or others. Assets represent the use of funds to generate income, while liabilities represent sources of funds. Liabilities include paid-up capital, reserves and surplus, deposits, borrowings, and other liabilities. Assets include cash balances, money at call and short notice, investments, loans and advances, and other assets. Now let's understand the liabilities of a bank in detail. The first liability is paid-up capital. It refers to the contribution made by the shareholders of the bank. It indicates the bank's liabilities to its shareholders. Reserves and surplus is the amount accumulated out of undistributed profits by the bank over the years to meet contingencies. Deposits are a primary source of funds for banks. Deposits are classified as deposits payable on demand and deposits accepted for a term. Current deposits. These deposits are operated by business persons with no restrictions on the amount or number of withdrawal. Banks do not pay interest on such accounts. Savings deposits. These deposits are owned by individuals and trusts for non-commercial purposes. There are restrictions on the amount and number of withdrawals for such deposits. Banks pay some interest on these accounts. Term or time deposit. These are deposits repayable after a specified term and have different maturity periods depending on the interest rate. They include fixed deposits, cumulative deposits, and annuity deposits. Borrowings consist of refinance obtained from the RBI, commercial banks, and other financial institutions. They also include overseas borrowings made by Indian branches of the bank and the borrowings of foreign branches of the bank. Other liabilities are incurred by the bank in the course of its business. They include bills payable such as draft, travelers' checks, payslips, and bankers' checks. Interest accrued on deposits and borrowings but not due is also included in other liabilities along with the provision for income tax. Moving on to assets. The first asset type is cash balances. A part of the cash balance is held by the bank to meet customer requests for withdrawal. A certain proportion of cash is held in the form of deposits of other banks as well as with the central bank. In India, commercial banks are obliged to keep a certain proportion of their total deposits in the form of cash reserve requirement or CRR by the RBI. Cash does not earn any income for a bank. However, it is the most liquid asset. Next is money at call or short notice. This refers to the short-term loans made by the bank in the money market. These loans have maturity varying from 1 to 15 days. Banks borrow from other banks to meet a sudden demand for funds, large payments, large remittances, and to maintain cash or liquidity with the RBI. These assets are highly liquid because they can quickly be converted to cash. They generate some interest income for the banks. Investments by commercial banks are of the following three types: Government of India securities or SLR securities, other approved securities, SLR securities, non-approved securities, non-SLR securities. They earn income for banks, however, they are less liquid. Investment in SLR securities. Government securities include securities issued by both the central and state government agencies and public sector undertakings or PSUs of the state and central government. Quasi-government securities or approved securities are given the status of SLR securities on a case-to-case basis. Investment in non-SLR securities. Non-SLR securities include commercial papers, units of mutual funds and shares, bonds and debentures of PSUs and the private corporate sector. Next is loans and advances. The following are the types of loans and advances offered by commercial banks: cash, credit, and overdraft. They are the running accounts from which the borrower can withdraw funds as and when needed up to the credit limit sanctioned. Cash credit is sanctioned against the security of commodity stock, while overdrafts are allowed on current accounts. Interest is charged on the outstanding amount borrowed and not on the credit limit sanctioned. Purchase and discounting of bills. Bills are purchased and discounted to finance trade transactions and the movement of goods. Bill finance is either repayable on demand or after a period not exceeding 90 days. Loans can be of two types: demand loans and term loans. Demand loans. These are loans repayable when demanded by the creditor. They are mainly short-term loans. Term loans. These are loans sanctioned for a period exceeding 1 year. They have a specific schedule of repayment. Other assets include fixed assets such as premises, which are wholly or partly owned by the bank for business or residential purpose, and furniture and fixtures. Thank you.